Copper just had one of the biggest runs in a decade, climbing more than 40% in a single year. So, if you want to own that boom, the simplest move sounds obvious. Buy the metal itself. CPER promises to do exactly that. But the way it does, it hides a cost most buyers never see. CPER is the United States Copper Index Fund, run by USCF Investments. It markets itself as the original copper ETF, and unlike a fund full of mining companies, CPER is built to track the price of copper directly. No mines, no CEOs, no balance sheets. Just the red metal that wires the modern world. And right now, that metal is everywhere in the headlines. Copper is the backbone of electric vehicles, power grids, and the exploding build-out of AI data centers, which need it for cabling, transformers, and cooling. With analysts forecasting supply deficits for years, CPER now holds close to $800 million in assets. Here is how it actually works. CPER does not own physical copper sitting in a warehouse. Instead, it buys copper futures contracts on the COMEX exchange, fully backed by short-term US Treasury bills. Each month, a rules-based index checks the futures curve and decides which contracts to hold, then rolls them forward before they expire. And that rolling is the catch. Futures contracts expire, so the fund constantly has to sell the expiring one and buy a later-dated one. When later contracts cost more than nearer ones, a situation called contango, the fund effectively sells low and buys high every single month. That quiet, repeating cost is a headwind that can eat your returns even when copper itself is rising. Why does this happen? Because a futures-based fund is not the same as owning the metal. The structure that lets CPER track copper without a warehouse is the very thing that creates the roll cost. On top of that, CPER charges a hefty 1.06% expense ratio, and because it is legally a commodity pool, it sends you a Schedule K1 at tax time instead of a simple 1099. That K1 can complicate your tax return in a way most ETF buyers never expect. Now the part that really stings. Over the past year, copper miners, tracked by the fund COPX, returned more than 100%. CPER, the pure metal play, returned about 9%. The supposedly simpler, safer way to own copper massively trailed the messier one, because mining company profits rise faster than the metal when prices climb. So who is CPER actually for? It is for an investor who wants exposure to the copper price specifically, without the risk of a single miner missing earnings or hitting trouble at a mine. It is a clean bet on the commodity, not on management. For short-term tactical trades on copper, that purity has real value. But be honest about the trade-off. You are paying a high fee, accepting a tax form most people dread, and giving up the explosive upside that mining stocks can deliver in a bull market. CPER does one job, and it does it narrowly. If you are weighing copper right now, here is my question for the comments. Are you team metal with CPER or team miners with COPEX? Tell me which side you are on and why. If this breakdown helped, hit like and subscribe because the next ETF you are curious about is probably already on the channel.